Welcome to the Money Runner. I'm David Nelson. The Federal Reserve cut rates by a quarter point on Wednesday. But the real story isn't the size of the move. It's the lack of conviction behind it. Powell calls it a risk management cut. Now, I'm not sure I even know what that is. I don't think I've heard that before. But the truth is, the Fed is once again pulled in two directions. Inflation is still running hotter than they'd like, while the labor market is clearly softening. Instead of clarity, investors are left with a muddled message and a familiar question. Is the Fed leading or just reacting? As bad as that sounds, investors understand all too well they're standing in front of a Fed that has entered into a cutting cycle alongside rising earnings and an administration pushing every growth lever to run the economy hot. It's just not profitable. I think legendary hedge fund guru David Tepper said it best on a recent CNBC broadcast. I'm constructive because of the easing right now, but I'm also miserable because of the levels. If you're watching this podcast, you're probably thinking the same thing. I'm on the train, and I don't want to jump off too soon. Well, if you're going to go for the ride, you're going to need a roadmap with a few signposts to tell you when it's time to jump off. So with a little help from my friends, I've got two triggers that every investor should be on the lookout for. Check it out. I'm David Nelson, and I am the Money Runner. Before we cut to the chase and what investors should be on the lookout for, let's unpack the market balance sheet. Assets on one side, liabilities on the other. The asset side is easy. Every bull market needs earnings, and this year and next are expected to deliver 12 to 13% growth. Those estimates have been rising weekly. Number two, rates are falling. The Fed has embarked on a cutting cycle, and right now street projections are that the Fed funds will be at about 3% this time next year. The pace at which we get there is important. The president wants to see fast cuts. I get that. But if we get 50 now, it might spook the market. Investors will believe the Fed sees something they don't. Deregulation. The administration is doing everything it can to remove the regulatory overreach that has built up over the last several years. And that's money that cuts right to the bottom line of almost every company. Business-friendly tax policy. Accelerated depreciation schedules for qualified new and used assets. And finally, AI. Arguably the most important secular growth investment cycle we've seen in our lifetimes. And we are likely still in the early stages of a theme that could run for years. Liabilities. The liability side of the balance sheet is real and has to be discussed. At least for now, the deficit is still growing. Yes, it's true accelerated growth could help reduce it, enforcing the concept we can grow our way out. However, if history is any guide, government almost always finds a way to spend new revenue as it comes in. Valuations, the elephant in the room. We've talked about valuations in the past, and yes, it's true, we're hitting some lofty levels. In fact, we are approaching the 2021 levels right now. And it wouldn't take a lot to get to levels last seen during the dot-com cycle. But valuations are a lousy timing tool, and markets can push higher for years. Finally, suspect data. I want to focus on this for a second. The issues with the data at the BLS, Bureau of Labor Statistics, is real and can't be ignored. There was only one question at the FOMC press conference on the BLS data and the massive revisions. Jay Powell's answer? It's good enough. I'm sorry, wrong answer. It isn't good enough. and it likely hasn't been good enough for years. The non-farm payroll data that we get each month is dependent on a set of surveys where the response rate has fallen to 60%. The BLS is using some of the same methods established in 1915, well over a century ago. Maybe that was okay in previous decades, but 25 years after the birth of the internet and the information age, there has to be a better way. We should be using real-time data inputs instead of surveys with falling response rates. By definition, if you know the data you rely on is suspect to large revisions, you're going to move slower, which is in fact exactly what the Fed does. They react instead of being proactive, hence they are usually late. Take a look at this chart of Fed funds going back a half century. Almost every rate cutting cycle was followed by a recession, in large part because the Fed was too late to hike or too late to lower rates. Maybe it's different this time. All right, I said we get there. What are some of the data points or signposts we can use to help guide us to a decision to reduce exposure? Number one with a bullet, CapEx spending on AI infrastructure. The last couple of years, the CapEx spend on AI infrastructure has been growing hand over fist. In fact, in a recent post earlier this week, I showed how often analysts get this wrong. At the start of the year, we might be looking at 15, 20%. 3 months later, it's 55%. Neil Azus, founder and portfolio manager at Rareview Capital Management, brought this up on a recent call with our advisors at Belpointe. He pointed to the massive CapEx spend at Meta, which looks a lot like a lot of other hyperscalers. If Mark Zuckerberg, out of the blue, suggested they were going to cut back on their CapEx spend, markets aren't going to like it. At a minimum, there would be a repositioning of capital out of tech into other sectors of the economy. Another signpost, credit spreads, the spread between corporate and treasury yields. Bad things in stocks usually start in the bond market. Right now, corporate credit spreads, they're fine, narrow in the lower quadrant of the historical range. Keep your eye on the credit spreads at many of the tech darlings that have to lever up to deliver on some of their promises. I've pointed out Oracle in the past as a hyper-growth AI play, killing it on sales and orders, but free cash flow is negative and likely to be that way for years. During the dot-com bust, widening credit spreads served as an early warning sign that there was increasing credit risk, which translates into growing skepticism. Look, these are just 2 data points, and of course only a small part of a tool set we're going to need to navigate a challenging but one of the most dynamic investment cycles in my lifetime. I hope all this helps. Don't forget, if you want to learn more about yours truly or the Money Runner, go to my Substack site, dcnelson123, at substack.com. I'm David Nelson, and this is the Money Runner.